Welcome to today's session. In this set of videos, we're going to look at three interconnected concepts central to corporate finance: capital budgeting, cash flow estimation, and project risk analysis. These tools are going to enable us to evaluate long-term investment opportunities, allocate our resources wisely, and ultimately enhance firm value. Capital budgeting is more than just crunching numbers. It reflects strategic decision making. Every new project, whether it's building a new plant, launching a product line, or acquiring another company, requires careful cash flow analysis and risk assessment. We're going to learn how to estimate future cash inflows and outflows, discount them appropriately, and then assess the risk-return trade-off. We're going to begin by looking at a project. This project has costs $240,000, $200,000 in actual assets, $10,000 in shipping, and $30,000 in installation. Now, this is what we refer to as its depreciable basis. That's how much we can depreciate this asset for. It has economic life of 4 years, salvage value $25,000 at the end of the 4 years. We're going to depreciate it on a maker's 3-year class analysis. As far as operations, we're going to sell 1,000 units, $200 per unit, costs $100 to make the product. Our net working capital requirement is 10% of sales. Our tax rate, 25%. The project's cost of capital, 10%. And we're going to assume that all prices and costs increase at 3% a year. Now, this is just a really small picture of all the variables that we need to kind of lumping a lot into one group here. But this is how we're ultimately going to work our way through to calculate the incremental cash flows and then ultimately to analyze the riskiness of the cash flows. So when we talk about this concept of incremental cash flow, that's the foundation of capital budgeting. It represents the additional cash flows generated by a project. So it's the cash flow with the project minus the cash flow without the project. So what this does, it means that we can ignore corporate-wide averages and isolate the project's specific impact. For instance, if Amazon is evaluating a new data center, we only account for the cash flows directly attributable to that center, not to the entire company. Now, if we're adding a business, right, or we're replacing assets, we already have a business in place, we'll have cash flows of the company with the project, and we'll have cash flows without. So we're actually going to have to forecast two sets of cash flow statements, actually. If it's a brand new project, then there's no current ongoing process, so the estimation is really just one thing: estimate the cash flows moving forward. So this formula allows us to play with a lot of different types of projects. What do we do about financing costs, right? Should we subtract interest expense or dividends from our cash flow calculations? And of course, this is a common mistake, is to include these costs in our calculations. And we don't include them because our cost of capital already reflects investor return expectations. Including these costs in our estimation would be double counting those costs. there's something called sunk costs. This is like money spent on a feasibility study or site preparation in prior years, right? We've already spent the money. We're never going to be able to recover it if we don't do the project, so it's just spent. So we don't want that to influence our future decisions. So again, sunk costs are not included in our estimation. Now, this is one thing that companies get to do what they want to do, right? So if a company wants to include sunk costs in the initial cost of the project, certainly they can do that. The issue for that is it would actually be increasing the investment cost, which would then have the effect of reducing the net present value of the project, which obviously affects value. Opportunity costs are very important because they represent some form of foregone benefits. So if we were using a building for a new project, right, and that project, we used to get $25,000 a year on that space, but now we're going to put a project in there, well, we lose that $25,000. That's an opportunity cost. So we would have to incorporate that into our forecasting of each year's inflows because we're now not going to receive that. Externalities can both be positive and negative, right? They also, obviously, they have a big impact. So if our new product eats into existing sales, that is, it's cannibalization, that's a negative externality. Conversely, a complementary product that boosts sales elsewhere, that could be a positive externality. But again, we need to take these into account to make sure that our cash flows are, again, representing the incremental cash flows of the company total, not just what the project does, but if it has other influences on the project or the company, we want to include it there as well. So what is a project's depreciable basis? Again, we have our definition here. It's the cost plus any shipping expenses plus any installation. So in this particular project, it's $240,000. So determining the basis is obviously very important. These expenses represent the non-cash deductions from income. They reduce taxes. So many new changes to the tax code. We'll talk about those a little bit later in this presentation. But we're going to utilize what's referred to as the maker's depreciation system. This comes from our workbook. We have a capital budgeting depreciation worksheet. It's also in the project worksheet for capital budgeting. But here you see $240,000 is the initial cost. Makers is 3 years. There's installation cost. Well, in this case, we just put it all up in here. But really, the cost here should have been the cost plus installation or plus shipping. Then we would include installation. But again, we have the total value. And as you can see, Makers calculates for us 1, 2, 3, the 4 years of depreciation for this asset that we buy. So why is it important to include inflation in estimating our cash flows? It obviously plays a key role. Cash flows and discount rates must be treated consistently. Nominal cash flows, those which include inflation, have to be discounted using nominal rates. Failing to account for inflation can distort our net present value estimates. So realistic projections should adjust revenues and costs by inflation rates to better reflect future economic conditions. One of the tricky parts to this, then, is that not everything is affected by the same inflation rate. Sometimes there are differences. So, simply stated, it's easier to include inflation in our projects than to try to estimate and remove inflation from the discount rates. So we're going to assume that all of our forecasted cash flows have been adjusted for inflation. So in our project, we have estimated the future revenues, again, $200,000. Again, we also talked about there's some growth each year. We also have a change in expenses, or the actual change in expenses that will occur. We know what those are. They're going to grow every year. So we end up with something referred to as the change in EBDT. Now, some projects, again, some homework problems, they might tell you what this is, in which case you would just type it in there. But in this case, you need to calculate it. And of course, it's just revenues minus expenses. But the acronym here, earnings before depreciation and taxes. Remember, we don't have interest. We're not going to do interest because that's in the weighted average cost of capital. So that's enough for this video. Let's wait on the next one to figure out how this project moves on. See you soon.